If you're looking to house hack and or you just can't qualify for a conventional loan, go FHA. Literally every other scenario you could think of, go conventional. There you go. I just saved you 10 minutes or however long this episode is. That was my intro to this episode last year, but actually, since then, there have been some updates to the multifamily guidelines on the conventional side that make the house hacking thing not as cut and dry as it used to be. But you're probably wondering why behind that statement I just made. So let's get into less details. We're going to talk about credit requirements, down payment requirements, mortgage insurance, rates, loan limits, and seller perception, because who cares about all that if your offer doesn't even get looked at. We're going to talk about the amendatory clause, something that scares realtors and therefore scares realtors' clients. So definitely stick around for that. Now, if this is your first time hearing the sound of my voice, my name is David. I have a background as a mortgage underwriter, lender, and realtor. So yes, that is the entire home buying process. I purchased multiple homes myself, but most importantly, I've helped hundreds of people just like you buy their first home in real life. I don't just talk about it on the internet. Let's go get those keys. Jingle, jingle. Welcome back to House Rich, the first time home buyer show where we provide you actionable steps in layman terms to buy your first home. Let's get right into it. The big debate, FHA versus conventional. And we're going to start off with credit. So the credit requirements for a FHA loan are a little more loose than the conventional requirements. So you may hear a lot of folks run around talking about, hey, you can get an FHA loan with a 500 credit score. Yes, on paper you can, as long as you put down 10%. But here's the thing, there's something called lender overlays or additional guidelines that lenders can put in place in order to raise that minimum requirement set by the FHA. Translation, not all lenders and most lenders will not allow you to get a FHA loan with a 500 credit score. In the rare requirement you can find a lender that will allow you to go down to 500, they're going to require you to put down 10%. So you have to be the rare person that has, honestly, let's be real, a 500 credit score is poor credit. So poor credit, but you've managed to somehow save a bunch of money, 10% down for the property. Most likely you're going to be shooting for the minimum credit requirement of 580, which is where you put that 3.5% down you hear so much about. But stop there for a second. Still, some lenders, once again, due to those lender overlays, will not go all the way down to a 580 credit score. Some lenders are going to want you to be at least a 620 credit score in order to meet their FHA lender overlays. But if you do find somebody above that 620 down to 580 or below that 580 down to 500, please believe you will get killed on your interest rate. So let's say right now the average rate is a 7%. We hear that 7%, that is for somebody that has like a 740 credit score. So your interest rate is not going to be 7%. You're going to be in like the 8s, mid 8s, potentially 9s, especially if you're that low bottom of the barrel. Like I said, let's be realistic, bottom of the barrel as far as credit scores all the way down to 500, because your credit score is an assessment of your ability to meet your financial obligations, whether you want to believe so or not. And so due to more risks, the lender is going to charge you a higher interest rate. Now let's get to the conventional guidelines. Well, the minimum requirement for a conventional loan is a 620 credit score. And most lenders would be like, hey, our minimum requirement is 620. Here's the thing though. In my experience as a lender, I have not seen anybody qualify for a conventional loan with below a 630 credit score, because below 630, there's some sort of issue on your credit, whether it's a collection, a late payment, or something like that. You don't have the strongest credit profile. I'm not saying it can happen, but a lot of stars have to align for you to qualify for a conventional loan with like a 620. You really want at least a 640 credit score, and your best pricing is going to be around the better pricing starts around 660, 680. So you may recall the story from the summer where evil Joe Biden, he penalized people with good credit and somehow made it so people with poor credit had a better interest rate. Of course, that was kind of a misconstrued story, but what did happen was those loan level adjustments for people with lower credit were reduced so they could get a little bit better interest rate at the lower end of the credit spectrum. But I want to reiterate, there is no scenario where somebody with a lower credit score gets a better interest rate than somebody with a higher credit score. Everything else equal, despite what you may have seen from your favorite finance pro. Let's talk down payments. For an FHA loan, as I said, below 580 is 10% down. At 580 and above is 3.5% down, whether it's a 1, 2, 3, or 4 unit property. That used to be the huge allure of an FHA loan, and still is, which is you could buy a 4 unit property, live in it, and house hack, and only put down 3.5%. Because with a conventional loan, it used to be whether you lived in the property or not, your down payment was like 15 or 20%. But there have been some changes to the FHA guidelines as far as the down payment. So let's go over the conventional down payment requirements. If you're buying a single family property, whether that's a townhome, a standalone single family property, the traditional, house with the picket fence and all that, or just a condo, that is either 3% or 5%, depending on your status as a first-time home buyer. If you're looking to buy a multifamily property and planning to live in the property, the new update is that for a 2, 3, or 4 unit property, your down payment is only 5%. So that is a huge change to the conventional guidelines where it went from potentially 15, 20, 25% down to 5%. Now, what if you're not looking to live in a property? Because with a conventional loan, you can buy a vacation property or an investment property. With the FHA, it's primary residence only. Well, for a vacation property, your down payment is going to be 10%. A vacation property is any property you do not live in as your primary residence and someone else does not live in it either. A multifamily property cannot qualify for a vacation property because there's literally other units in there. So by definition, someone else would live in the property. Now, an investment property is any property that is not your primary residence, but somebody else lives in. The key word there is lives in, because if someone's living in there and still you're not charging them rent, like say it's a cousin or like you're a family member, by definition, because somebody's in there, it is still an investment property, whether you're collecting rent or not. And so the minimum down payment requirement for an investment property is 15%. Now, you may be wondering, well, hey, what if I stay in an FHA property for a year? Do I have to sell it? Can I move out? Can I turn that into a rental? Yes, after a year, you can move out of the FHA property and turn it into a rental property if you so fancy, or a vacation home as well if you're moving out of the general area. Now, which one has the better rates? Well, it kind of depends on the lender, but traditionally, you're going to get a better rate on an FHA loan than a conventional loan. So you may think, okay, I have this lower rate on a FHA loan. That seems like a huge win. Maybe, maybe not, because we got to get to mortgage insurance. And the big thing here is that mortgage insurance stays on the FHA loan forever. And somebody's probably thinking, well, I've heard that if you put down 10% that the FHA mortgage insurance drops off after 11%, which you probably haven't heard that unless you listen to me talk about it. That is true. If you put down 10% on an FHA loan, originally, the mortgage insurance, yes, it does drop off at the 11-year mark. But let's be realistic. You're not putting down 10% on an FHA loan. You're using the FHA loan to put down 3.5%. Now, with a conventional loan, the mortgage insurance drops off once the loan to value ratio reaches 80%, which is a huge, huge plus because mortgage insurance can be $200, $300, $400 depending on the loan size. So while you may be in a scenario where the FHA loan has a lower rate and maybe a lower principal and interest payment, once that mortgage insurance gets dropped off for a conventional loan, that payment could drop significantly on the conventional loan. That's why weigh both options, but if the rates are close, even if the FHA loan is slightly better, it may make sense to steer yourself towards the conventional loan. But once again, go over those scenarios with your lender. You may be wondering, hey, what is loan to value ratio? Well, it's what it sounds like. It is the value of your property in relation to the amount left on the loan. So let's look at a very straightforward scenario. I'm a realtor in Dallas and would love to help you reach your goals of home ownership. So click the link in the description and just schedule a call no matter where you are on your journey. Not in Dallas? No worries, I can help connect you with a vetted realtor in your local jurisdiction as well. And feel free to share with friends, family, and foes. Everyone gets left. Let's say your home is worth $100,000. And you're thinking, hey, where can I get $100,000 homes? Yeah, I don't know either. And you put down 5%. So now you put down 5% or $5,000. So your loan to value ratio is 95%. Now, over time, your home appreciates and you pay down the loan as well. So that 80% loan to value ratio is a combination of the home appreciating and you paying down the amount of the property. Here's the thing though, your lender is not keeping track of the value of your property over time. They're only paying attention to the value of the property, aka the appraised amount when the home closed. So once again, back to the mythical $100,000 home. Well, if over time your home has appreciated to, let's say, 115, 120, and now that loan to value ratio is at 80% due to the appreciation, you have to go out and get most likely an appraisal. But talk to your lender and say, hey, how can I assess the value of my home in order to refinance and drop that mortgage insurance? If you say nothing to the lender, your lender actually doesn't drop the mortgage insurance until it reaches a 78% loan to value ratio. So you want to be keeping track of that value of the home yourself so you can drop the mortgage insurance as quick as possible. So going back to the FHA loan, the only way you can actually drop mortgage insurance on the FHA loan for most people is to, you guessed it or maybe you didn't, is to actually refinance into a conventional loan, which could potentially cost you a couple $1,000 as well, which you can actually you don't pay that at closing. Typically lenders will roll that into the loan balance, but still you're adding a couple $1,000 back to the balance of the loan. So essentially pay that couple $1,000 when you go to sell the property. So once again, if things are close, you just want to start with a conventional loan in the first place. Now, with your debt to income ratio for a conventional loan, most lenders will go up to about 49.99%. With an FHA loan, you can technically go up to like 55%, but for the most part, with a conventional loan, lenders want to see it about a 45% back end of your debt to income ratio, back end being all your debts plus your future mortgage payment. With a FHA loan, lenders want to see you typically with a 31% front end ratio and a 45% back end ratio. Front end ratio being just your future mortgage payment divided by your income before taxes. Once again, back end being your future mortgage payment plus your monthly finance debts divided by your income before taxes. But here's the thing, once again, honestly, in either scenario, you should be nowhere near a 50% debt to income ratio because that means your real life DTI is probably close to like 70, 80, 90%. That is a recipe for disaster for your finances, but I guess do whatever you want. But that is my little warning to you. Let's talk loan limits. For an FHA loan for a single family property, your max loan limit is $498,275. For a 4-unit property, that loan limit goes up to $958,350. Now, for a conventional loan, those loan limits are considerably higher. For a 1-unit property, your max loan limit is $766,550. So yeah, that's almost $300,000 more for a conventional loan. And for a 4-unit property, that loan limit is $1,474,400 and something. I cannot read my chicken scratch. But long story short, your loan limits are a lot higher for a conventional loan than an FHA loan, which gives you the ability to purchase more. But once again, focus on your budget, not how much you can purchase. But if your budget is good enough, you can buy a more expensive property with a conventional loan. So that's another like check mark there for the conventional boys. Last but not least, seller perception. I'm going to be very blunt and straightforward with this. If there are two equivalent offers, one is FHA and one is conventional, the conventional one will get accepted 99.99% of the time because realtors just flat out tell their clients conventional loans are better than FHA loans. And it's for a myriad of reasons. One is just to be straightforward, if we go back to the credit part I talked about, the perception is people choose FHA loans or only go FHA because they have poor credit, because those credit requirements are a little more loose. The natural thought is, well, if this person has poor credit, that means they have trouble meeting their financial obligations. So what about this financial obligation, which is purchasing this house? So there's that stigma there to begin with. But also there's some real tangible things that sometimes get blown out of proportion when it comes to an FHA loan versus a conventional loan. One thing is the inspection of the property. So like with an FHA loan, there are things that have to be fixed. So like we're talking about like light sockets, there's like gradients when it comes to the level of dirt in relation to the home and the angle it's set. There's bars that have to be not on certain windows. There are railings that have to be on steps. So there's literally deal breakers that the FHA will not approve for an FHA loan that sometimes can be negotiated with when it comes to a conventional loan. So a lot of times realtors don't even want to deal with that at all. And last but not least, probably the biggest thing is something called the amendatory clause. What it says is that if the home does not appraise for the value listed in the contract, the buyer can back out of the contract even after the option period. The option period being the time the buyer has to inspect the property and back out of the contract is usually like 5 to 7 days and still get their earnest money back. And let's say that's 7 days in this scenario. Well, if the appraisal comes back on day 17 and the sales contract says $300,000 and it comes back at $299,500, the buyer can just back out of the contract because maybe they got cold feet or they don't want to do this or that, and they still get their earnest money back. And as a result, this gives the buyer way more leverage when it comes to negotiating on that property, because two things. One, they can just back out of it, as I mentioned, get their earnest money back. And now the seller has to put their home on the market probably for at least another month, make a whole nother mortgage payment as well. And also that price sticks to the property for the next 4 months. So if another FHA buyer comes along, even if the sales price is still $300,000, they have to go off that appraised price too. So it gives the buyer a bunch of leverage in the negotiation process. Because in actuality, what happens with most conventional loans is, let's say there's like a $5,000 delta. Well, most times people just meet in the middle. It's like, okay, the home is listed at $300K. It came back at $295,000. Buyer, you come out of pocket another $2,500, and seller, you lower the price $2,500. So now we'll meet in the middle, and it'll be the sales price will be $297,500 will be the sales price we meet on. So yeah, those are the pros, cons with a conventional loan versus an FHA. So as you can see, there's a lot of kind of check marks on the conventional side versus FHA, but it's always like weigh both options with a lender. And as I said at the beginning, if you can't qualify for a conventional loan, maybe due to credit requirements, you got to go FHA anyways. But yeah, as always, buy land. Rumor has it they're not making any more of it.